So I'm Denise Chisholm. I started at Fidelity in 1999, and you should just think of me as somebody who sits in equity research. I have been there in various roles, but just like everybody else in equity research, the name of the game is to get the right names into our funds that you can then buy. I just do it in a very different way. Most of our fundamental analysts, they talk to individual companies, they build company models, and they talk about individual securities. I don't do that. I talk about sectors, I talk about industries, I talk about factors, and I do it all through a very data-driven approach. So I'm finding historical patterns in the data that are still true despite the fact that every cycle is quite different. So I usually say, you're not going to hear me talk about my opinions. I can if you want me to, but they're not the most interesting. You're going to hear me talk about the data that I think is relevant to whatever question we're asking as investors, the probabilities associated with that data, and then how you can use those probabilities to make money. So that is the goal. I think I lost my presentation. There it is. So what you are seeing is the investment research update, which I present quarterly to any client who wants to log on to fidelity.com/IRU. So usually as a backdrop of performance, it has a sector scorecard, which we're going to get to in a second, which are my preferred sectors, recommended underweights and recommended overweights. And then I go into the meat of the presentation, where I usually talk about some critical macro themes and then some call outs for what sectors I think look really interesting to buy and what sectors I think look really interesting to sell. But before we get into that, let's talk a little bit about the scorecard and the orientation of this. So I just presented this data 2 or 3 weeks ago, and there was no change to the strategist view column. But I say you don't just get my opinions or my recommendations, you get also the data, because all of my opinions are based on data. So at Fidelity, we have the synthetic Russell 3000, which proxies the S&P 500. Going back to 1962, we have 10 or so valuation indicators. We have 15 or so fundamental drivers like earnings growth and other things. And we have all of that data for sectors, industries, and sub-industries. So we have a very rich history. What you see in the scorecard of pluses and minuses is for fundamentals like earnings growth, operating margins, ROE, and then valuations like relative price to book or relative forward PE, and things like relative strength, momentum, so upside relative to the market. You see, looking back to 1962, judging everything versus the S&P 500 versus its own history, the top 3 sectors get pluses and the bottom 3 sectors get minuses. So it gives you some ranking. So it gives you the data set of where we are, who's doing well, who's cheap, who's not. It doesn't tell you which sectors look best. That's inherent in the probabilities associated with the data. So if you look at the strategist view column, the recommended overweights are the green boxes, and you will see I have a very clear economically sensitive sector bias. Consumer discretionary, financials, industrials, information technology, and real estate are my preferred areas of overweighting in the S&P 500. Recommended underweights are communication services, consumer staples, which are quite defensive, which have seen a resurgence in this quarter, but we're going to get to that. Energy stocks, which if I go quick enough, we'll get to in this presentation. Healthcare, materials, and utilities are all recommended underweights. Again, the pluses and minuses don't necessarily port to those. So what you can see in real estate has 2 minuses on relative strength, so there's no momentum there, and fundamentals are quite poor. And I'm saying, yet I think that they look interesting and you want to own them, mostly because when you look at the data, the worse the fundamentals have been, the more likely the stocks are to outperform the S&P 500 over the next year. Why? Because most times the stocks have already discounted that bad news in advance. So that's why I give you the data to the right, but I tell you the probabilities inherent to my strategist view on the left. So let's talk about the market backdrop. Now, first, I did this presentation 2 weeks ago, but I started to put it into compliance, I think 8 weeks before that. So tariffs weren't at that time top of mind. To the extent that you are interested in the way I'm talking, in the data that I provide, and what I'm about to say, you can find all the data and the charts on my LinkedIn feed if you have a LinkedIn account, so you can subscribe to Charts of the Week. Now, the interesting part about tariffs is, as much as it's quite unprecedented in the magnitude that we've seen, I do think the context that we can think about tariffs is not evaluating tariffs in a historical trend, but evaluating tariffs as a shock to the US economy. So let's think about how we got here. We got here, we're almost at a bear market, right? At the low, we were down 20%, almost. Intraday, it was worse, but technically it's not a bear market. So how did we get here? Well, tariffs at 30%, which is what the administration's reciprocal tariffs came in at. So we had $3.2 trillion of imports, 30% tariffs, roughly is about $1 trillion in tariff income. Now, the problem with assigning tariffs is how much of a shock that's going to be to the consumer is that we don't exactly know which pieces of the puzzle fit where. How much is going to hit the consumer? How much is going to get substituted away? How much is going to be absorbed around corporate profit margins? Some might be absorbed by the exchange rate, and some might be absorbed by the foreign producer. But if we make some guesses, and we have to make some guesses about how much of it hits the US consumer, based on the 2018 instance, maybe about half does. Half gets substituted away, and half gets absorbed in corporate profit margins, and half gets absorbed elsewhere. That half is about $500 billion hitting the US consumer on about $25 trillion of income. That's about a 2% hit. This is important to calculate because when you look back in history, we always struggle. I remember in 2022, are we entering a recession? Everybody thought we were going to have a recession. Why are recessions so difficult to predict? They're difficult to predict because they come from shocks. And shocks in and of themselves are difficult to predict. Now we can scope it. What's the level of the shock that has been the tipping point? Well, when you go back through history, we have direct hits of up to 1% income. We've seen those tax increases in 1968, 1993, and in 1982. And in all of those situations, consumption growth was positive, meaning the US consumer was able to grow through a 1% headwind to income. Once you get to 1.5 to 2.5% of a shock to income, that's been the danger zone for recessions. It's never come from tariffs. Historically, it's come from oil prices or the Fed. So that's the context of why the market sold off very quickly. To the extent we end up around 30% weighted tariffs, that is a potential danger zone for a recessionary event. But if we end up around 10% universal tariffs, plus or minus, that's only a 1% hit to income. That's not enough, historically speaking, to tip us into recession. Why? Not because 1% isn't a hefty headwind. It's because usually there are offsets that you're not thinking about. Let's throw out some that might be true this time. The decline in oil prices, right? The opposite of the oil shocks that we saw in the 70s. That is actually about a $200 billion tax cut to the US consumer. There may be a bill with even additional tax cuts through the extension. That might be as much of another $100 billion. So all of a sudden, you have some offsets for the consumption headwind that may not be recessionary. So there will be a lot of strategists that will struggle with, well, let's think about what tariffs could be and then what the impact of tariffs on the economy will be as a result of some assumptions. I'm not going to do any of that. Why? Because the market has already reacted. We had the fastest time to a correction, 10% correction, since 1900, and we had the third speediest bear market since 1957. This is important because stocks have moved. So instead of struggling with what might happen as investors, we need to spend some time struggling with what the market has discounted. And there's a couple of points I'll highlight now before we get to this chart that are on my LinkedIn feed. One is that if we just look at all of the bear markets since 1957, and once they cross that bear threshold, let's just say that at the low, we'll call it a bear, and we'll say we crossed it. If you closed your eyes, you hold your nose, and you just buy stocks, how would you do if you woke up 1 year later and you opened your eyes? 80% of the time you'd be higher, and you'd be higher by about 20 percentage points. The only times you haven't been higher are those three big secular bear markets that we're all very afraid of: 1973, the dot-com in the early aughts, and then obviously the financial crisis in 2008, 2009. So outside those three, you've been up 100% of the time over the course of the next year by about 30%, meaning that you retraced all the way to the highs, which is not to say that the lows are in. In fact, most times after you hit bear market territory, you either retest those lows or you go marginally lower. But it is to say that there's opportunity, because the downdraft of 20% discounts an awful lot. So there is a pattern here that's important. And the pattern is that speed to the bear market. And we're going to get to this slide next. That speed to the bear market is linearly correlated. I show you a scatter plot on that LinkedIn feed. Linearly correlated. The speedier the bear market, the more likely there is to be upside and the bigger the return of the S&P. In fact, those three secular bear markets were defined by the fact that it took you 300 days to get to bear market territory. We're not there. That's not our situation. And of course, it could always be different. But if it's not, and the pattern holds, this is more like a crisis, more like a panic, or more like a war that, again, discounts a lot very quickly, can cover a lot of ground for the market to be able to climb that wall of worry. So that's the note. So let's talk about other statistical indicators that we can look at that show precisely the same thing. So the chart on the left, so this is the AAII percentage of bulls in the weekly sentiment survey. There are a bunch of different ways to measure sentiment. I picked this one, and the interesting part about it was that it is the fastest bull to bear transition that we've seen since the Gulf War. Back to the pattern recognition. This looks a lot more like a crisis or a war than anything else. The fact that there are basically no bulls on the survey is, right-hand chart, predictive. I'm not just cherry picking the data and saying, well, you know, you're at 19%, that's below 20. This happens less than, I think, 3% of the time. If I look at all those instances, again, holding your nose, I'm not talking about, you know, the fact that there might be more downdraft, holding your nose, buying, you woke up a year later, what would your returns be? 20%. But this is the more important pattern that I want to recognize. The more bearish your sentiment is, the more likely the market is to be higher over the course of the next year. There's this monotonic stair-step pattern of the opposite of what you would expect. So we are seeing sentiment capitulate in ways that we have not in quite some time, and it's not just this indicator, and the right-hand chart shows you that that's usually a contrarian buy indicator and usually protective to returns. So that's the message from this slide, is that there might not be any bulls anymore, so who is left to sell? And we've also seen a defensive rotation. So because I look at sectors as opposed to just the market backdrop, I think one of the most intriguing ways to look at sectors is the pattern that you usually see in a fear, a panic, or a recession, when investors crowd into anything they think is safe, and it's always the same sectors. Consumer staples, because you go buy your toothpaste; healthcare, usually because you go to the doctor, ex the COVID example; utilities, because you pay your utility bills; and the old telecommunication services. So we saw the quickest flight to defense, given the tariff announcements, that we saw since the financial crisis in 2009. And in fact, at the time I presented, it was 1,000 basis point rotation. It's now up to 2,300 basis points, which is about 70% of the way through a recession. So back to the struggle over not what the news flow might bring, but how far we went to discounting recession. Well, we got 70% of the way there. So it's true that if we come in at that 30% tariff rate, and that's a 2% hit to income, and we tip into a recession, we haven't fully discounted that. But if it's anything else in the middle, all of a sudden you could set up for more upside than investors expect. And I think, again, looking more over a 1-year time horizon, whoops, where did my, there it is. Looking more over a 1-year time horizon, if you said, just statistically tell me, after you've seen 1,000 basis point rotation like this, do I want to buy defense? Chart on the right shows you that the bigger the rotation of defense, the more likely defensive stocks are to underperform over the course of the next year. Again, there's that linear relationship. If you look outside the bubble where basically anything worked ex tech, what you will find is this top 3% rotation, which is what we're seeing on the left-hand chart, shows you that you give up not only, most of the gains, but all of the gains from that panic rotation over the course of the next year. So I think the message from this chart is we've come a long way to pricing in a recession. We're not all the way there, but given we priced in so much, I think you want to stay open-minded to the alternative, that if it doesn't come to fruition, we might be ending up in some of the similar situations that we found ourselves in 2022, where we discounted a recession that didn't end up happening. So we always have to be mindful about upside in the equity market, mainly because the equity market has a very rich history of discounting bad news in advance. Let's talk about DOGE and what that might mean in terms of cutting government spending. So what you see is federal outlays on the left-hand chart, which is just another way of thinking about government goods and services. And certainly you've seen some back and forth with the COVID pandemic, but obviously government outlays have been decidedly elevated over the course of the last 3 years. So the concern is, from an economic perspective, hey, if we don't have the Fed cutting very much, and we have fiscal policy actually contracting because of DOGE maybe over the next year, isn't that a problem for stocks, the market, earnings, the economy, all of it? And what you find is the opposite of what you think happens. Right-hand chart shows you that when outlays grow the fastest, that's usually the situation where stocks aren't up that much. And when you see that outlays do contract, meaning that you had perfect foresight and you know government spending is going to go down, that's actually been the best setup for stocks historically. Isn't that odd? Now look, some of this, and it relates to GDP, is around the fact that there are recessions in here. So when you see GDP during that top quartile, hey, we know government's going to spend a lot over the course of the next year, that's usually a bad sign for the overall economy. Only 76% of the time does real GDP growth advance during that year. But when government spending is contracting, usually you have a situation where the private economy is growing. So you end up in a situation of 100% odds, historically speaking, the GDP has grown over the course of the next year. And that's true even outside recessions. Even if I just said, forget the recessions, take them out of the data, re-quartile of the data, look at the green bars, what you will find is it is still, if you knew with perfect foresight that government spending was going to contract, that is a situation that earnings grows the strongest, stocks do the best, and the economy grows the best. So why is that? So I was an econ major many years ago. So I think if we're thinking about the debate of two theories, which is fiscal spending is stimulus for the overall stock market, right? There's a multiplier effect and the economy does better when the federal government is spending. Or there's an alternative theory that says the more government spending there is, the more crowding out the private sector is done. And if we're looking at the debating those two answers, this data shows that, well, if you had to bet on one of those theories being correct, it would be the crowding out theory. So we may end up in a situation where even though the government is cutting spending, private sector growth is filling in that vacuum, and the economy, stocks, and earnings growth do better than you would expect. So I think we have to be cautious of using the lack of government spending as a reason to sell stocks, given this data. This is one of the most hotly debated ideas, I would say, that I have based on the data. I talk to a lot of our portfolio managers, and one of the biggest questions I get is, well, look, Denise, there's so much uncertainty out there. Nobody knows anything. I talk to all of our companies, and nobody's spending and nobody's hiring because nobody knows what to do. So we can evaluate, quantitatively speaking, uncertainty levels. So the left-hand chart shows you trade policy uncertainty. It's higher than that now. We can even have aggregate uncertainty that aggregates trade, healthcare uncertainty, economic policy uncertainty, fiscal policy uncertainty. And what you will find is it is more uncertain now than it was during COVID. So what corporate America is faced with now is more uncertain than a pandemic where we shut down the global economy. So the question is, that sounds bad, right? Quantitatively, can we evaluate it? Let's look and see if there is a relationship between the level of uncertainty and future returns. And just like we were talking about before, it's the opposite of what you would expect. So if you see a pattern, it is a nice stair-step linear pattern, very monotonic. The higher the level of uncertainty, the higher your risk-adjusted returns over the course of the next year. Doesn't make any sense, does it? You will find also CapEx look this way, as does hiring looks this way. Meaning, when your starting point is, we have no idea what's going on, once the second derivative improves, doesn't have to get certain, just has to get less uncertain, you have already been not hiring, which is true. There's no firing, but there is no hiring either. You have already not spent CapEx. That is true. Manufacturing is in a recession. You know, you are seeing other indicators that are negative in that area. Core capital goods is not growing. And that second derivative improves the trend. So I don't see uncertainty as a reason to stay on the sidelines. In fact, I see uncertainty almost as if it's an alpha signal, or maybe in this case, a beta signal. The higher the level of uncertainty, the more I am interested as an equity investor to say, we might have already discounted that bad news in advance. You can say it differently in the sense that if you wait for certainty, you have missed the move. And this was no more evident than in the recessions of the 1980s. So when I ask investors where they think the low was in the market between 1976 and 1985, most people remember that we had two back-to-back recessions, and the bigger recession was in 1982. So most people say, well, it was sometime during 1982. No, it was in 1978, before either of those recessions took hold. It was when Paul Volcker came in and said, I am going to raise rates to crush inflation, and if we have to do a recession to do it, so be it. So you could have closed your eyes, held your nose. 5 years later, you went through exactly what you thought maybe you would go through. Two back-to-back recessions, the first time that ever happened. The second, the longest and deepest since the Great Depression, and you would have made money in equities because the low in 1982 was higher than the low in 1980, those two recessions, and the low in 1980 was higher than the low in 1978. So that's the power of the discounting mechanism of the market. And that's why I am very intrigued with this setup. But let's talk about some other positives very quickly. So positives for a sector for financials specifically, and then I'm going to flip to a sector that I don't think is a positive risk reward of energy. So financials, the interesting part on this chart, the left-hand chart shows you the small business survey. It's the net percentage of respondents saying that credit is hard to get. The interesting part about 2022, why we did not officially see a recession, I always call it a very hard soft landing or a very soft hard landing, but I think we landed. Small businesses and manufacturing absolutely saw a recession. They were in some ways in a credit contraction all the way up through recently. And this has been the first time we've seen an inflection in this survey from credit is very hard to get for small businesses to actually a bottom quartile event. Now, the right-hand chart shows you that's really important because there's a very clear correlation between that left-hand chart and what happens to loan growth, right? The easier credit is to get going up that stair-step pattern, the more likely loans are to grow and the higher the loan growth seen over the course of the next 12 months. This is important because loans, when you look at aggregate loan growth, have not grown that fast at all. And this is the odd thing. So there are certainly a lot of sentiment indicators that have fallen off a cliff given the tariffs that we've seen, but loan growth, and we get this data weekly, keeps on chugging along. So I think that there's something to be said for the deregulation that's actually being put forth in the economy and the really strong reserves in the banking system that are still being able to have upwardly focused loan growth. And this, if you said, what sector has the best risk reward? If you think credit for small businesses has finally inflected, that is related to loan growth. Loan growth is confirming the survey signal. Which sector do I want to own? Right-hand chart shows you should be most interested in financial stocks. And that's not the only reason. So I've been writing about financials, I think for the last 18 months as my preferred interesting sector. And it was really all around the fact that valuation was low enough relative to the market, relative to its history, that I didn't care so much about what happened to earnings growth, net interest margin, loan growth, or anything else. It shows you that there's historically been this great, rich history of financials being able to discount bad news in advance when they're cheap enough. And when they're cheap enough, I define it as bottom quartile, relative forward PE versus its history. And once you're there, you find 65 to 75% odds of outperformance over the course of the next 12 months, regardless of if net interest margins contract or if earnings growth contracts, which is a way to say, look, I think a whole lot was priced in already to financial stocks, and now we have a potential catalyst of loan growth that's monotonically related to future outperformance. I think the risk reward for financials as a sector is still positive, despite the outperformance we've seen over the course of the last year. So I do want to talk about energy stocks as a sector not to own, mainly because I get a whole lot of questions about them. And I will say, as an investor, I really like to be able to own energy stocks because they're such a small portion of the S&P 500. So if you overweight them, you can make a really big difference in your portfolio relative to just aggregate stock returns. And I will say that the one very glaring buy signal that actually happened coming out of the pandemic is a contraction in demand. If we do get in a situation where there is a global recession, you should know to look for that decline in energy demand overall, and that is like a bell ringing saying, be interested as an investor, because once demand contracts, you usually have priced in that contraction, and that upside is usually pretty severe in the market. Again, we saw this coming out of the pandemic. Obviously, you see this massive outperformance, but now we've reversed all of that. So there are many investors who are saying, well, energy's underperformed by an awful lot. That must mean there's a mean reversion trade. And in fact, it does not, right? So once you have right-hand chart, worse than 15% underperformance over the course of a year, which is exactly where we are, how do you go on to do? You go on to, on average, underperform again by another 200 basis points, meaning there's not a whole lot of mean reversion trades in energy. There's a whole lot of momentum, either positive or negative. And right now, we're seeing negative momentum that we wouldn't want to get as investors in front of. This isn't a mean reversion predictive indicator. Why is energy in the crosshairs? I'm happy to discuss in the Q&A if you want. US supply and the share gains relative to OPEC. I'm happy to talk about OPEC's recent price cuts and increases in excess capacity or increases in output. But really, at the end of the day, it's all about fundamentals. The left-hand chart, again, this is our data going back to 1962. I probably should have put it on a log scale. But this is aggregate free cash flow, right? How many net of operating expenses, how much cash flow is the entire energy sector generating? And you'll see, I mean, I think that the interesting thing in 2020 was, despite the fact that, remember, crude had that -19 print, they were still generating positive free cash flow at the bottom of the cycle. That's how much they cut capital expenditures, because everybody was asking them to. But fast forward to today, what we're seeing was the best profitability environment that energy has ever seen. So again, I showed on the left-hand chart, free cash flow, but you could think about operating margins, you could think about returns. It has never been better in all of the history of my data than it was in 2022. And that's a problem, because this does mean revert. And what we're seeing is, until we get to re-normalized free cash flow or operating margins, and we're not there yet, you end up in a situation where most of those are still likely contracting. How do we do when we're in the bottom half of free cash flow growth, or less than 20%, which is where we are? Well, on average, we underperform by about 150 basis points. That's how it usually ends up. And if you're wondering, as an energy investor, well, shouldn't valuation provide an offset? Valuation has statistically provided a lot of offsets in financials, certainly in technology, which I'm happy to talk about in the Q&A, but it has not historically in energy. If fundamentals are going against you, being cheap doesn't improve your odds. There's a little bit quantity to say to individual investors, but energy is the only sector that statistically gets on that trough earnings when when there's a recession and earnings growth contracts by 40%, they get trough multiples. They get 5 times earnings. Unlike technology stocks, when if you have a contraction in earnings growth of 20%, multiples actually advance and you get 20 times earnings. Energy does not do that. It has never done that. You can bet on the fact that it's different this time, but generally speaking, I do not. So that's a summary presentation. I definitely wanted to leave 10 minutes for Q&A, although I could talk a lot longer. So again, if you're interested in the presentation, you can always go to fidelity.com/IRU. But tariffs, we don't know how much of a shock they might be, but we need to struggle with what the market is discounting. I think it's discounted about 2/3 to 75% of the way through a recession. So we need to think about potential alternatives. Within those alternatives, do you want to be economically sensitively biased, or do you want to chase those defensive sectors? I think you want to bias towards those economically sensitive sectors. Financials are one, energy is not one. And I would say at the top of your list should be within technology is software. And again, keep an eye on the charts of the week on LinkedIn for an update on technology stocks, which had the biggest multiple compression that we've seen in technology in quite some time. All right, with that, I definitely want to leave questions.
Great presentations, and I'm seeing the questions come in here hot and heavy. Speed to market. You had an analysis that this is one of the quickest declines for large caps to occur. Does that apply, that type of reversion, quick reversion, apply to small caps as well?
It should. So all of that, so from a nominal perspective, it absolutely applies. The scatter plot looks the same if you look at the Russell 2000, the Russell 3000, the S&P 500, the S&P 100. What it doesn't help you figure out is if small caps should do better than large caps. That is not, it doesn't help at all. There's no information content in that.
Actually, let's see here. How do you measure trade uncertainty? I guess that's a very, you had a slide on that.
Yeah, so there's a bunch of different metrics and a bunch of different organizations that measure it, and it's all through sort of scraping newsletters and news headlines into the angst over how many times something is mentioned. So it is usually like a count. And I did a similar analysis on like recession, which was trending in Google. It's very similar in how many, like what's the count in terms of you see this. And the more you see it, the more likely it already is in everybody's consciousness, and the more likely it is to be priced in.
Someone here had an observation that it's interesting that the energy sector you said is more momentum based, not mean reversion as far as its analysis. Are there other sectors that are similar to energy? I mean, it sounds like technology might be the opposite. Are there sectors that people should look at the same way?
Materials and energy are very similar from that perspective. When they underperform, they usually continue to underperform as opposed to mean revert. Materials is a sector, they usually, they're not even as good as energy in the sense that while we can debate commodities from a nominal perspective, most materials stocks don't generate free cash flow like the energy stocks do. So there is just a continuous negative momentum, is even at the peak of the cycle, they generate less and less free cash flow.
So it's interesting. So it's the fundamentals of the industry that plays that role then. It's interesting.
Correct.
Can you discuss your views on the technology sector?
Yes. Oh, so I just wrote a note on this. So again, I'm data driven, so I let the data come to me. In the bear market, what my job is as an equity researcher is to find the opportunity, find the anomaly, see what's most predictive. And in the downdraft, we have finally gotten the technology sector back to median levels of relative valuation. So for 18 months, I've really been talking about financials, I've been talking about consumer discretionary, I've been talking about real estate, and everybody wanted me to talk about technology. And I said, look, technology is fine. I think it's okay. I think it's a risk reward positive, but you're hanging out in these top 2 quintiles of relative valuation. That hasn't necessarily meant you want to short the sector, but it usually means that there's other sectors that are to invest in better. Now, largely that was wrong from a trajectory perspective, but if you fast forward to today, the interesting part about the downdraft is technology for the first time in 5 years is back to median levels. That's the level that has usually been the sweet spot for outperformance, and it's not because fundamentals are good, it's even true if fundamentals are not good. Back to that, technology stocks have a rich history of discounting that bad news in advance, provided that they've underperformed, and oh, how they have underperformed, right? So that underperformance, even if margins decline, because everybody wants to say, well, wait a minute, the next shoe to drop is going to be earnings. Everybody's going to pull guidance, take down earnings, revisions are going to come down, numbers are going to come down. I don't want to get ahead of that. And I think that, look, that might be true over the course of 3 months. Over the course of a year, this is exactly the interesting part, because usually, statistically speaking, the stocks look through all that because they've already moved and covered the downside. So I do find technology for the first time in a very long time really intriguing from a sector leadership perspective. And for those who want to go a click down, it's software within it. If you think about the 3 subsectors, hardware, software, and semiconductors, it's absolutely software that has the biggest valuation support and still the highest operating margins.
Interesting, very interesting. How do longer demographics play a role as far as looking at different sectors?
Different sectors. So sectors, not at all. The overall economy, a little, right? You would say that demographics are deflationary and would predict lower inflation and lower interest rates over time. So that's the big sort of macro driver. For, as much as you would say that the biggest driver or the biggest corollary would be healthcare, there's absolutely no relationship from healthcare outperformance to demographics. It's much more driven by operating margins and starting point on valuation. So the tricky part about healthcare, demographics aside, are they kind of scream like a value trap to me. The sector is absolutely cheap, and by absolutely cheap, I mean bottom quartile of whatever indicator you'd like to measure it on. But operating margins peaked in 1999. And the last 2 years, margins have declined more than most other sectors, with the exception of consumer staples, which had the largest 18-month operating margin decline in any sector ever in the data. So sure, you're cheap, but what do those normalized out-year operating margins look like, even with a demographic boost? So I think as it relates to sector investing, demographics don't mean a ton, but I think inflation is definitely harder to get than many investors expect. I don't think the tariffs are inflationary. I think they're deflationary over time. I don't know what could happen over the next 3 months, but over the next year, I think the tariffs act like a tax that are more likely deflationary. And I think that that's supportive of, at the end of the next cycle, I actually think that interest rates are low again. and inflation is 2% again.
That's interesting. You're the second economist I've heard make a similar analogy to the tariffs as far as being more of a tax than an inflationary issue. Do you have any thoughts on gold and or Bitcoin dynamics?
Yeah, so I just wrote a note on Bitcoin. I think that that's going to go on LinkedIn. I'll talk to, so gold first and then Bitcoin. Gold as a commodity, the most interesting commodity, right? Because it's actually a store of value and it's in a long-term uptrend. So if you think about, your diversified portfolio, I've got equities, I've got bonds, I've got commodities, I've got alts. From a commodity perspective, gold is definitely the best commodity. From a stock perspective, do I want to own gold equities within the S&P 500? Not so sure. And it's all around what we just talked about with free cash flow. If there's ever been miners out there, it's the gold miners that lose more money every single cycle because they have to spend more in CapEx to get that gold out of the ground. So it's not really a perfect representation. So if you want to own gold as a commodity in your commodity portfolio, it doesn't necessarily mean that gold stocks will beat the rest of the S&P 500. I'm not telling you shouldn't own any, but I'm just telling that I don't think it's all that interesting. Now, Bitcoin, it's funny, I get a lot of questions on Bitcoin. Is it correlated to gold? Is it correlated to the dollar? Is it correlated to inflation, deflation? It's actually correlated to equities the most strongly. It really is, so far, over the last 3 years, a risk-on signal. And in fact, the key chart, and again, you'll see this in the charts of the week that's about to be released, is the rolling negative correlation to the relative performance of the utilities and consumer staples sector. So again, rolling negative correlation. This is all the way going back to 2014. Those are your defensive sectors. So when Bitcoin goes up, they underperform. When Bitcoin goes down, they outperform. This is a bell ringing of sort of a risk on thing. So look, we saw a big inflection in Bitcoin. Who knows if it will hold because it's Bitcoin, but it is meaningful to watch. If it continues, stays here or goes higher, I think we have to be open-minded that Bitcoin might be signaling the end of a defensive rotation and actually a resurgence of leadership in technology stocks.
That's very interesting. I know you have a hard stop and you have to get going soon. So if someone wants to follow you, what's the best way they should go ahead? And I know you mentioned chart of the week. How would they go ahead? And we'll include the links when we send out the email. But what's the best way that you said on LinkedIn? Is that?
Yes, that is the best way. You should go to LinkedIn. You can follow me there and you can subscribe to charts of the week. And then you can always go to the quarterly webcast on fidelity.com/IRU. I also do a monthly, if you like listening to me as opposed to reading. Some people like it, some people don't. You can listen to my Market Insights podcast. That's on Apple, on Spotify. You can find it on fidelity.com. It's usually me talking through my charts of the week, and then I also do a Q&A with some other investors, sometimes our portfolio managers. So those are the 3 areas you can find me. Charts of the week on LinkedIn, where you can subscribe to the newsletter, the Market Insights podcast, if you prefer to listen to me and want a Q&A with our PMs, and then the quarterly webinar called the IRU, which is fidelity.com/IRU.
Well, again, thank you so much for your insights. It was very enlightening and it gives